Do you plan to begin your stock investing journey very soon? Creating wealth in the stock market takes time and patience, as well as discipline and commitment. If you're doing typical mistakes that investors make, it won't be possible for you to yield great results. There are numerous sources and experts that will teach you things on what to do. But don't forget to be mindful of things that you should not do as well. Stop making these 7 dumbest beginner investing mistakes in the stock market to get the highest return on your investment. Number 7. One of the worst investing mistakes you can do is failing to start early or thinking you are still too young to invest. Time is your best tool when it comes to investing because it allows the power of compounding to perform its wonders. Compounding happens when your capital earns interest and the interest earned also gains interest. The sooner you begin to invest, the longer time your money will have to compound. It is like your money working for you even while you sleep. Number 6. While not starting to invest as early as you can is a huge mistake. Investing before you are in a financial capacity to do so is also a giant mistake. First, see to it that your finances are not in a mess, and then you can begin investing. Tidy up your credit, eliminate credit card and other high-interest debts, and save for an emergency fund that can cover you for 3 to 6 months' worth of your living costs. After you've completed this, you will be able to start getting your money work as you sleep. Number 5. Ignoring the need to do your due diligence. Quite a lot of people look at investing as if it were a lottery ticket. Make sure you don't invest in anything that depends on chance to succeed. Conduct your qualitative and quantitative research, and compare potential investment opportunities to other investing options. Ask yourself if you have the essential knowledge to evaluate stocks, index funds, exchange-traded funds, and other securities. Now, more than ever, are we given all the information we need in doing research through the internet? Make sure you do your homework before investing your money. When you know the fundamentals of the company you are invested in, your judgment won't easily be influenced by outside factors like market news and volatility. Number 4. Having short-term focus. Don't be lured to get-rich-quick schemes in the stock market. Maintain a long-term perspective. A return that is higher than the market average is considered a great return on investment. But that is not going to make you rich overnight. Keep a long-term approach and have the discipline to ride out the storms and volatility while watching your investments grow. Big capital gains are achievable, but quite impossible to achieve on a consistent basis. But it's very possible that you'll be able to achieve a consistent good return over a longer period of time. The truth is that your investments will yield lesser at certain times, and you will make bigger returns in the short term at other times. There will also be instances when you'll have negative returns for a short while. But as long as you invest in solid companies and have a long investing horizon, you will gain better returns over time. With a long-term mindset centered on high-quality equities, you can make decisions without the pressure that comes with short-term trading techniques that chase follow movements. By following a long-term approach, investors get a much higher likelihood of weathering the storm and profiting from the power of compounding, as touched on earlier. Number 3. Using the media as your first source of information. Majority of financial talk show hosts tend to put more emphasis on what is currently trending in the market. They gain more views by talking about what the market wants to hear. They earn money by giving tips and advice, mainly for their vested interest, rather than reflecting the true fundamentals of underlying stocks. They may hype up a stock they own and sell it after they make their huge profits, leaving the retail investor suffer losses on their investments. If any one of these people could accurately forecast the market, they would end up some of the world's richest people. Don't let their so-called investing advice make you act on impulse. Rather, utilize their stock tips to explore potential companies you will be researching on in the future. Number 2. Keeping losers for too long. This has to be the bottom, or it won't fall any lower. Any shareholder has declared at some point, Even some of the best of companies have gone bust, with share prices plummeting to under $1. It happens. Sometimes the fundamentals of one company can permanently change due to economic shifts or mismanagement. Stick to a falling stock only if you have the underlying grounds to expect it will recover. It is better to take smaller losses than completely losing your capital by being defiant to toss in the towel. Before getting into number 1, don't forget to hit the like button if you are getting any value from this video. With that said, here is number 1. Failure to keep track of your investments. Once you've hit that order button and get your shares, your duty isn't over. The present time might present the share you invest in as a solid, strong, and dominant company. That doesn't guarantee it'll keep up with times over a few years or so. Exxon was the company with the largest market value in the US only 10 years ago. But it is not even included in the top 20 today. You don't need to monitor your investments on a daily basis, but you have to be abreast of its fundamentals and relevance in the present economy. For more life-changing videos like this one, make sure to watch the next one as you will definitely find a ton of value from it. Thanks, I will see you again.